Hey there, and welcome. So, today we're going to tackle a topic that could feel, well, pretty complicated: mutual funds. You hear about them all the time, right? But what are they really? We're going to cut right through all the jargon and give you a super simple, really powerful way to understand exactly how they work.
If you've ever looked at a list of mutual funds and just felt your eyes glaze over, yeah, you are definitely not alone. The number of options out there can honestly feel like you've been dropped into a maze with no compass. It's confusing, and it's totally normal to feel that way.
But what if I told you there's a map? And it's a really simple one. By the end of this, you're going to have a 3 question checklist that'll let you look at any mutual fund and just instantly get what it's all about. So let's unfold this map and start with question number 1. First up, we need to understand the fund's basic structure. You can think of it as its blueprint. And the big question here is, how do you get your money in and out? This brings us to our very first classification. Is the fund open or is it closed? Okay, so most funds you're going to run into are open-ended. Just think of it like a store that's always open for business. You can buy into the fund or sell your units back to the fund company pretty much any business day, and the price is based on its net asset value, or NAV. It's all designed for a constant flow of money in and out. Now, a closed-ended scheme, that's a different beast. It's more like a special concert with a limited number of tickets. The fund raises money during an initial offer, and then bam, it closes. If you want to get your money out before its official end date, you can't just sell it back to the fund. No, you have to sell your units to another investor on the stock exchange, just like you would a stock. So let's just put them side by side real quick. Open-ended funds, constant access, easy liquidity right from the fund itself. Closed-ended funds. Okay, so we've got the blueprint down. Now for our second question, who's in the driver's seat? Who is actually making the investment decisions? This is all about the management style, and it boils down to 2 options. Is it active or is it passive? An active fund is run by a professional fund manager or a whole team of them who are kind of like star chefs. They're actively researching, handpicking investments, and constantly deciding whether to buy, hold, or sell. Their goal isn't just to cook a good meal, it's to create some unique, signature dish that's going to outperform everyone else. A passive fund, on the other hand, is like a master cook who's following a famous classic recipe down to the last gram. There's no creative flair here. The only goal is to perfectly replicate a market index, like the Nifty 50. The fund manager's job is just to buy and hold the exact stocks in that index, in the exact same proportions. Simple as that. So here's the crucial difference. Active funds are trying to beat the market. You're betting on the manager's skill, what people in the biz call alpha. Passive funds are just trying to be the market by tracking an index as perfectly as possible. And because of that simpler goal, they often have much lower fees for you, the investor. And that brings us to our third and final question, which is honestly the most important one, because this one is all about you. What is the fund's destination? What is its whole point? Is it designed for growth, for income, or for liquidity? If a fund's destination is growth, its one and only goal is to make your initial investment bigger over time. That's capital appreciation. It usually does this by investing in stocks. Now, the thing about stocks is, historically, they've done really well over the long haul, but they can be a bit of a roller coaster in the short term. So these funds are really best for people who have time on their side. But what if you're not just trying to grow your money? What if you want a regular paycheck from your investments? Well, that's the destination for an income fund. These guys invest in things like bonds that pay out interest. The goal is to collect all that interest and pass it on to you. But, and this is super important to remember, while the goal is steady income, it is not a guarantee. And finally, some funds have a really simple destination. Just be a super safe parking spot for your cash. These are liquid funds. Their main jobs are to protect your original investment and make sure you can get your money back like right away. They invest in very safe, very short-term stuff. Perfect for stashing extra cash for a few weeks or months, but definitely not the place for long-term growth. So there you have it, the blueprint, the driver, and the destination. We've just built the map you can use to navigate this whole mutual fund universe. Let's just quickly put it all together so you know how to use it. From now on, whenever you look at a fund, just ask these 3 questions. 1, what's the blueprint? Is it open or closed? 2, who's the driver? Active or passive? And 3, what's the destination? Growth, income, or liquidity? Answering those 3 things will tell you pretty much everything you need to know about what that fund is trying to do. And this right here perfectly sums up the main idea. This quote from our source says it all. The destination, the fund's objective, is what determines everything else. It tells the fund manager what to buy, how to manage it, and what you, as the investor, should expect from it. It all flows from that single point.
So the next time you're staring at that maze of investment options, you're not going to be lost. You've got the map. So really, the only question left to answer is the personal one. Where do you want your money to go?